I'm Simon Brown, coming at you live and loud from the Moneyweb studios in Gauteng, Johannesburg. On the show today, we've got Kieran Nyana. He's EA Capital. Growthpoint trading update. It's tough. Mr. Price results. It's very tough. Fred Razak, he's chief trading strategist at CMTrading. The rise of big tech. I mean, it's up, almost 38% so far this year. What's driving it? Perhaps more importantly, what for the rest of the year? And then some thoughts from me. Inflation, so all one-way traffic back into the target range and maybe rate cuts this year. The show is brought to you by Stanlib. Visit stanlib.com to get in touch with one of their investment specialists. Stanlib Asset Management is an authorized financial services provider. Morning headlines from Moneyweb. Scientists sounds alarm on failing water systems. I tell you, water's our new Eskom and it's going to be way worse. Business Day, Just Share study highlights SA's yawning pay gap. Shoprite's CEO earned 1,081 times more than the company's internal minimum wage in 2022. Morning markets, US was green, S&P up 0.4%, Nasdaq up 1.2%. Asia is red, Sydney down 1%, Tokyo down 1.6%. Commodities red across the board. Gold 1,921, Brent 73.65, Platinum 926, Palladium 1,275, Rand 18.59, Bitcoin 30,000 on the nose, 10 cent down 1.75% in Hong Kong, and top 40 opening call 180 points to the red. That is 0.25% down.
Moneyweb now on the money. Also available on podcast.
Trading now with Kieran Nyana. He's head of global markets and structured products at EA Capital. Kier, appreciate the early morning. Mr. Price results. I mean, flattered because of acquisitions. Without those acquisitions, comparable store revenue down some 3.4%. They're getting more credit sale requests. Nothing we didn't know, I suppose, which is it is really tough out there for consumers, and clothing is fairly discretionary. We've probably already got some clothes. They might be old and tatty, but they still serve their purpose.
True, Simon. And I think what these counters are suffering from in terms of pricing has been a crisis of confidence. And I really think that the economic reality of what these companies are facing is essentially being shown in the share price. And I think Mr. Price suffered from just not being able to prepare for the new economic reality. And that's what dug a hole into its profits. And what I mean by that is available hours during load shedding.
Yeah.
Where if you compare it with True Words had an availability of about 63%, the Foschini Group just slightly more, where Mr. Price was at about 33% availability. And this has stuck a big hole in the profitability of this company.
Yeah, that's a great point. They just simply can't trade. They also had, much like we saw SPAR had their SAP problem installation, they had an enterprise resource planning system which went pear-shaped. I remember ShopRite had problems years ago. I mean, when large companies do large tech upgrades, they almost always go wrong. And I know that's a cheeky thing to say, but the evidence does seem to suggest that's right.
And it really starts being glaring in economic times and economic times where they're not profitable. I think if there were budding businesses and revenue was going stronger and costs were being able to be controlled, I think it would be negligible. But I think in times like these, there's more evidence for shareholders to see. So I really think it's just quite a problem to have right now, but albeit a problem still needing to be fixed.
Yeah, I take your point. You can't hide it in tough conditions. Growthpoint came out with an update. I mean, rent reversions on renewals still negative 14%. It's improving. My line for me, performance of the office sector appears stable. There's many moving parts here, but I mean, REITs are still having a tough time. Office, really bad. Retail, struggling. And industrial and logistics, the sort of shining light, but tough in REITs.
And to be perfectly honest, this is the worst performing sector over the COVID period, over the 3 years. Global property and local property has underperformed all other sectors on bourses globally. But I think if you really had to start taking a nibble in this sector, this would be one to look at just purely for its diversification play. It has good spaces in the retail, good spaces logistics and commercial, even has an investment fund. But right now, I think what's really a concern has been in the commercial property space, where occupancies are seen to be improving, but not seeing the kind of improvement that shareholders would want to see, and it's very tough.
Yeah, it is very tough. And looking at that share price, man, it's only 10% off the pandemic lows. I mean, it's basically gone sideways since those levels and well off the pre-pandemic highs. We'll leave that there. That's Ken Nyana. He's head of global markets and structured products at EA Capital. Kia, always appreciate the early morning insights.
Your money gives a damn. If it could protest and sign petitions, your money would. But your money can do more than that. When you invest in Stanlib's infrastructure investment fund, beyond getting solid returns, you are helping to build a more sustainable future through job creation and positive economic growth. Damn right you are. Invest for more impact at stanlib.com/more. Stanlib Asset Management is an authorized financial services provider.
Moneyweb now on the money.
I'm chatting with Fred Razak. He's a chief trading strategist at CMTrading. Fred, appreciate the time today. Talking tech stocks. I mean, it's been a phenomenal year if we look broadly. I mean, Nasdaq up 38% after the horrors of last year's bear market. It really has been a tech year, and we're not even halfway through yet.
Absolutely. It's been a revival.
If we draw into some of these stocks, for example, Nvidia, I mean, that's all around AI. That's all around sort of where the future of tech is. There's a stock up 200%. I mean, is AI something which is really worth being on the watch list? I mean, it's going to be the future, surely.
It's the future, and it's already here. This is the thing. And you said Nvidia like I used to say Nvidia. For some reason,
Yes.
It's Nvidia. And I'm on your side. I say Nvidia. Anyway, so this type of technology is here now. It's happening. The full application of it, we're not going to see into the next 5 to 10 years. And that means that these companies that people are investing in them, like Nvidia or like Microsoft or like Facebook, which is Meta now, they're at the cusp of really running this race. And it reminds me of the year 2000 when it was the internet boom, where everybody was trying to get a hold of a company and they didn't even know where it was going to go. But now you have the major computer companies, the major tech stock that are just fighting against each other for space. And in the arena of what they offer the public, it's going to be kind of interesting.
I remember back in 2000, the .com, I'm old enough to have been around in those days. I mean, you make a point, Google, for example. I mean, in the 90s, Google wasn't even a search engine that anyone knew about yet, and now it's the dominant one. And I suppose in a sense, we're trying to spot those big winners, and stocks like Nvidia, Microsoft, who's obviously got the core stake in OpenAI, are probably easy spotters. What about some allied stocks around there, or do you focus on the big ones?
So right now, it's a little bit hard to say which ones are going to be the next Google. Google kind of came in, let everybody do what they did, and they came up with a superior product, and it just went with wildfire. And they took it from there, and then they took acquisitions on YouTube, and, they saw the next thing. And I think right now, these big major corporations like Microsoft are situated in a very good position. But remember, just like everything else in life, you can't do everything all the time. So there are going to be a lot of opportunities around smaller companies that are just maybe thinking of the idea just now. And it's not going to actually hit the market for another 3-4 years. So you have to look at how the market's going to respond to it. Okay, what's going to take off in the realm of AI? Is personal healthcare going to take off? Is it going to be security is going to take off? You're going to have to see exactly, because AI has lots of applications.
Yeah.
Which ones are marketable is going to be another story.
Yeah, I mean, we all think, ChatGPT, DALL-E and the like, but actually the scope is almost limitless. I want to touch quickly on Meta. You mentioned Meta. Mark Zuckerberg really went all in on the Metaverse. Heck, they changed the name of the company to Meta. He seems to have backpedaled on that. Is that a good move for them in the sense of saying, look, the Metaverse is coming, but maybe it's not worth tens of billions of dollars every year at this point?
Well, if they're going to be the best at it, then potentially they're going to be the biggest dominant player in it. I mean, Facebook as it stands right now obviously has kind of done its product life cycle. I believe, with TikTok and Instagram that is coming out, like all this other alternative kind of social media sites are really taking Facebook to town. And Facebook hasn't really, updated. It hasn't done a facelift, so to speak, on Facebook. It looks like the same thing almost from 10 years ago. So I do believe that he sees the fact that his product is, kind of done its lifetime cycle, and it's time to invest in something that potentially will be the technology of tomorrow. Whether or not it actually fruites, that's going to be determined on the market. But right now, you're right. The stock is up almost tripled from what its lows were. So that's really a tremendous feat, just going from November 2022 to where we are now.
And maybe it's a case of also, we forget that some of these tech stocks were almost mature, and Meta one of them, and they need that new product in their arsenal. Otherwise, I don't want to say they become boring, but they kind of lose relevance. And you've seen it with Microsoft, with, for example, cloud, Azure, their desire to move into gaming as they reinvent themselves under, I was going to say the new CEO, but of course he's been there close on a decade now.
Yeah, and it's also the fact that it's not just the life cycle. They have to move where the money is going to be. And these companies, they're sitting on so much cash that they could just retire on the cash alone. But because they want to add value to the market, because they want to stay relevant, today, the gaming industry you mentioned is probably larger than the tech industry 2 or 3-fold.
Yep.
The gaming industry just itself is, one of the largest industries in the world right now. So this is going to be very interesting to see if these kind of companies are going to be able to evolve themselves into those next type of products.
Yeah, and I look at some of those releases of the new AAA games, and they do better than giant movies. The gaming really has taken off. If we end off by looking for the rest of the year, as I said up front, we've had a phenomenal start so far to 2023. We're not even halfway through yet. Do we take the view that the trend is there and stay with it? Don't try and stop a steaming train, because this is moving and there's momentum here.
So there is momentum. There is momentum. Not to say that people are not going to take some money off the table. We are still in an inflationary environment. Don't forget. The Fed has signaled that it's not the end of its tightening and possibly increasing interest rates. So those are two factors kind of to take into consideration. Technology industry is a sector. It's not everything. We still have real estate problems right now because the interest rates are so high, so prices of housing are going down. There's other factors. There's high unemployment. And there's other factors that are in the ecosystem of the economy right now that are not completely healthy. Whether or not the technology industry is going to be able to sustain the rest of the economy like it did back, at the onset of the 2020 pandemic, where we sold off and it was the tech stocks that took us higher and completely rallied the market. I don't know if you remember that, but towards July, August, the tech stocks were the first ones that went higher. Microsoft made new highs, Google made new highs, Amazon made new highs, and it kind of like reshaped the entire landscape. And we hit new highs, of 36,000 on the Dow. That was unprecedented. We didn't think that we would be there. And so the question is, can we repeat that now with the technology sector kind of carrying the rest of the market higher? That needs to be seen because, we're not in the same type of environment. We are in an inflationary environment. There is high, unemployment relatively to where we are in the industry. So it's going to be kind of interesting. This is definitely something that is going to expand even at these levels, Facebook trading at $283 or Microsoft trading somewhere in the $300 range and Nvidia trading in the $438 range. Are these like overpriced? Maybe not, because if it's going to be a trillion billion business in the next 5 to 10 years, then, these denominations are still relatively small compared to the upside potential.
I take your point on that. If we look forward 5 years, a decade, suddenly these prices maybe aren't quite so crazy. We'll leave it there. That's Fred Razak. He's Chief Trading Strategist at CMTrading. Appreciate the time today.